We are talking specifically about asset allocations, that mysterious world of what do you have and what do you owe and what's community, what's separate. We're going to talk about retirement assets. We're going to talk about the house. We're going to talk about how the law applies to some of these assets. We're even going to touch upon QDROs, that mysterious word that everybody doesn't know what it means, QDRO. And Cinda, who is our financial specialist, is going to be speaking first. Work on the demystifying. Kenneth Lee, who is an attorney, and I'm a divorce mediator. We're going to cover some of the legal aspects for you. Our realtor, we're not sure she can make it this evening, but we do have her cohort here. Emily is here. She's a lender, and they work closely together to talk about the home because, of course, the home is often one of your very biggest assets, and how it can be managed in divorce is very different in mediation than in litigation. Ken will talk to you. We'll do like a contrast and compare.
Yes.
So first of all, I want to thank you all for being here. We have a huge crowd tonight, and we're honored to be here. We have all been vetted by Vesta. So if you don't know, Vesta has been around for about 13 years now, maybe 14 by now. Started out of the East Coast with a mission to change the way people divorce, to give you options. And what they did is they went out and found us, they vetted us for you, and we work in geographic hubs. So you are with the Carlsbad hub, which means we all work here in California, specifically in the North County area of San Diego. Some of us can work all over the country. I only work in California. Ken only works pretty much in San Diego County. And Cinda, how about you? You work in California specifically? Yeah. And yeah, same thing for lender. Emily, you're in California, or do you work across state?
Yeah, for primary properties, California, and then for any other investment properties, I can go across the country.
Okay, so the information you're going to get this evening is going to be California specific. And we're what's called a community property state. And we'll explain what that means when Ken and I are chatting. So if you're not from California, you're still welcome to be here. Happy to have you. But some of this may not apply, okay? Additionally, we're here to inform, to educate, to connect, not to give personal advice. So thanks for all your questions. We'll try to field as many as we can. We have such a big group. We know we won't get to them all. Ones that show up again and again or repetitively, we'll make sure that we cover those as best we can. We will not invite you to speak live because we want you to be here confidentially, so you will not be called upon. And if you raise your hand, we'll just answer everything to everybody. We won't identify you to give you, again, your privacy. Let me introduce you to the whole team. Again, I'm Laura McGee. I am a divorce mediator. I'm also a co-parenting specialist, and I'm a divorce coach. My practice is located in the village of Carlsbad, California. I pretty much work anywhere in California because we now e-file all over the place and people don't mind mediating over Zoom. So I have that flexibility. I don't have to go to court. That's me. And the other half of my legal team. Ken, you want to introduce yourself?
Thank you, Laura, and hello, everyone. As Laura said, I'm the family law attorney of the Hub. My law practice, which I own, is dedicated 100% towards family law. That's all I do. So I handle all aspects of divorce, whether we're starting at the beginning with a petition or a response, and handling all the issues, whether it's child custody and visitation, child spouse support, dividing assets, dividing debts. And I also deal with many issues that come up after a divorce is final because sometimes the confrontation doesn't end. So sometimes people need to modify support orders or custody and visitation or what have you. So that encompasses my practice. I deal primarily in San Diego County. I have cases in every single San Diego County family law courthouse. So that's my realm. I deal primarily in litigation, fighting in court, but I have clients where I'm a consulting attorney and they're in mediation, and Laura and I will talk more about that this evening. With that, I'll pass it over to our amazing real estate team, Emily.
Thanks, Ken. So I'm Emily Palmer. I'm the mortgage broker for the Hub. I'm also certified in divorce. I've owned Crest Funding, our mortgage company in Encinitas, for a little over 20 years now. I've helped navigate the finances for hundreds of divorces over the years, and I've seen most scenarios from the amicable to the furthest from that. And my goal is to basically be a strategic partner and help guide you through the complexities of divorce and mortgage planning. We know that the family home is often the largest asset and the most emotional. So it's not just a house, it's also the memories that are involved, the stability, and all the financial security kind of wrapped in one. So I just help you plan out what your goals are with either selling the home, retaining the home, or deferring the sale. and seeing how possible those goals are for you or your spouse, and just help you navigate what that path looks like.
Yeah. Yeah. And so we're going to introduce you to Cindy because she's going to start off, given this is primarily a financial evening. So before I hand it off to Cindy to introduce herself and also to take over the first part of our webinar, if you have questions, can you please put them in the Q&A box and we'll do our best to respond. Also, there's a poll and we'd be happy to have you share with us where you are in your process because that informs us who we're speaking to, what our audience is. And we also, Vesta has a concierge. If you haven't already been introduced to Vesta, what they do is when our one is over, Vesta will reach out to all of you and ask you if you want to be connected with anyone in particular or even other members of the Vesta organization for assistance in understanding a little bit more and getting a personal consultation separate from tonight's information. So we're going to close off our cameras for now and give Cinda the floor. Take it away, Cinda.
Thank you, Laura. Thank you, everyone, for being here. I'm Cinda Johns. My work is with individuals and couples, and sometimes I testify as an expert in court in litigated matters. I focus entirely on divorce and the planning that you want to do during divorce so that you can have an idea of how things look after the divorce. So let's get into the subject matter. When you decide to divorce, you will be filing declarations. There's 2 declarations that everybody in California who's getting divorced, they have to fill it out. One is the schedule of assets and debt, and the other one is the income and expense. And it can feel overwhelming to gather that information, but you want to gather that information in a thoughtful way. And I'll leave it to Ken and Laura to talk about the cooperation factor in that. So we'll go through the list of the assets and some of the fundamental information that you need to gather or you need to take into consideration. What we see when we work with individuals or couples in divorce, sometimes they'll have an idea that this is the way it should go, or this is the way that it is. But divorce has its own encyclopedia of rules. And so what I'm going to do is go through the different asset types and talk about some of the considerations for each one of those. Let's start with the house. The house is a big deal for everyone. And in California, we've seen the prices go up dramatically, and interest rates have also gone up. And people want to, if they have a low interest rate, they want to keep that. So you'll want to be sure and listen to what Emily has to tell us about your choices in terms of buying someone else out or refinancing. But in some way, the equity in the house needs to be offset by another asset, either an investment account, cash, buying someone else by borrowing. And so it's the equity that has accrued during the marriage. Now, if there was real estate that was owned before the marriage, then we generally look to 2 important criteria or information. One is if somebody put separate property that belonged to them before the marriage, maybe an investment, cash, then they can get credit for the down payment on the house. And that's called a 2640 reimbursement. If someone had a house before they were married, then the couple moved into that house and then the mortgage was paid down, then what we do is a calculation that's sometimes called a Moore-Marston. And it's a percentage of the appreciation of the property from the date of marriage to the date of separation and maybe beyond. It depends on what the decisions are with the real estate. And then we look to what the mortgages were and what the pay down on the mortgage is. So sometimes what we have to do when somebody owned a piece of property before the marriage, we have to look at the title, what the title was, did the title change, and whether or not there was refinancing during the marriage and what money was taken out during the marriage. So the real estate component of this can be quite complex. And you will want to think about what might apply in your situation. What I suggest people do is create a chronology of the real estate. When was it bought? Where did the money come from? When did you refinance? What did you do with the money that you got from refinancing? And there can be other factors in that. So you want to start by listing the chronology of the real estate, each piece of real estate. And you can estimate the fair market value, but when we're doing the declarations, you have to provide supporting information for every asset. So that means you're going to provide a copy of your mortgage statement, your property taxes, and your taxes. So that's touching on the real estate subject, and it's near and dear to people, and it can be complicated, but it will help you to think ahead of time of what those issues might be. And then you can consult with a mediator, or you can use a mediator, you can consult with an attorney and expand on the concepts that apply to divorce in connection with the real estate. So now let's talk about investments. So if someone has inherited an investment, that would be their separate property in the divorce. If they had that asset before the marriage, but then they put community property money into that investment account, then it has a mixed character. It could have a separate property character component, and it could have a community property investment component. Those situations can be very complicated because we have to look at what the investments were, what they earned, what was changed, and sometimes it requires doing tracing. So tracing is when someone gathers up all the statements or everything you can get your hands on. Sometimes you can't get statements beyond 7 years, so that presents a difficulty. But if someone wants to claim that an account is separate property, then they might likely have to prove what the separate property is and what the community property is. And when an investment account is divided, it's important to look at what the basis is. What are the potential capital gains? Because sometimes we see people that will say, you take the Apple stock and I'll take the Walmart. But you really want to look at what the basis, that means what was the price that you purchased the shares at? What is it worth today? And what is the capital gain? Because you may be getting an asset that is a huge capital gain. And your thinking is, oh, I'm going to get that $200,000 investment money, and then I can sell that, and then I can go buy something, or I can sell it and I can live on it. If you've got huge capital gains with that money, then you need to know that ahead of time. So it's important to take a real clear look at all of the components in connection with exchanging property. Assets are like having a trading chip. I'll give you this if you give me that. But we have to take a look at tax consequences, what they are today, what they might be tomorrow, and how would you intend to use those assets? And does that make financial sense? Retirement accounts, as Laura was saying, they can be divided in different ways. If it's IRA accounts, we could add up all the value of the IRA accounts, and then you can just transfer maybe one of them. You don't have to divide everything mechanically 50-50. You can trade and we can equalize values. If it's a 401k, a 403b, a TSP, those, sometimes we need to trace those. We need to know what the value was at the date of marriage, if any. And then how did that grow or lose money? Because we talk about the rate of return, and it's a time weighted return. It isn't just saying, oh, it's 5% or 10%. We have to look at each stage of the retirement account and how much did that account or sub-account grow, and how much is separate and how much is community. When you divide a 401k, then you would need to have a quad, and that's an acronym for Qualified Domestic Relations Order. And that applies to what's called ERISA accounts that fall under a certain category with the IRS. If there's a TSP, then there's certain specific documents that have to be used to divide government plans or teachers, CalSTRS or CalPERS. They have their own division documents that we send those to people who specialize in them, because the plan division instructions have to follow the documents that were adopted by the plan. What you don't want to do is say, oh, okay, here's this money. I'm going to give it to you. You can cash it out, because there can be significant tax consequences. If you're under age 59 and a half and you just take the cash out of it, there can be a penalty. Plus the taxes. There's always the taxes. There's a special rules that apply in divorce for some accounts, like a 401k, a TSP, a 403b. The non-employee can get their part of that plan, but it has to be transferred by the correct plan document. And when they get a notice that account is available to them, they can roll it over into an IRA, or they can take cash. If you take the cash and you're the non-employee, then you pay the tax on it. So the employee isn't able to do that. The employee can borrow against it. The employee could maybe take money out of it, but then they would have, if they're under 59 and a half, they would have the penalty plus the taxes. So that's why it's important to know what each one of those pieces are and how you go about it. What I find is that when people want to work together, they can, and they just need to have the foundation of knowledge to make informed decisions. Sometimes people will say, I don't want to pay a mediator, or I don't want to pay an attorney, or I don't want to pay a financial person, but it's worth it to consult, maybe pay for some time, because you don't want to cause yourself more problems in terms of taxes and money and making an agreement. Sometimes people make an agreement, they sit down at the table together, they feel like they both know and understand, and they just start to move forward on that. And then when the consequences come around, there can be a really big problem. I've seen people agree to sell the house, and they think everything's all straightened up. But what they didn't put in their agreement and what they didn't take into consideration was the capital gains on the house. So if you sell it together, there's a $500,000 exemption against the capital gain. If you sell it later and you're single, then the exemption for the capital gains calculation is $250,000. And in connection with the house, you want to know, if you're over age 55, who's going to be able to transfer the property taxes for that piece of real estate if you're going to sell. If somebody keeps the house and they just keep whatever that real estate tax is, but then sometimes people negotiate helping the other person out or looking into the future. If that person's going to buy, then their property taxes will be higher. The other financial analysis that I think is really important for people to do is do a net cash flow analysis. We're human, and sometimes what we want just isn't going to pencil out, but we want it so bad that we don't want to look at the analysis. It's important to do that. It's important to look at all sources of income, what support might be. Laura and Ken can help you with that. I help people look at what their living expenses might be, high and low. You have to be able to look at both. And then what are the sources of income? What are the expenses? And what will your taxes be? And then is there money left over? So what you want to do is try not to want something so badly that you don't do the analysis to see whether or not it can actually work. One more subject in terms of the financial matters that bear scrutiny is life insurance. Because I've had people say, oh, there's plenty of life insurance. And so if so-and-so dies, then I'll get this and that. But we're sold life insurance. And what you want to do when you're getting divorced is take a look at how long that life insurance will last. Because term insurance stopped at some point. Maybe that's all the insurance period of time that you needed. But if you're counting on that for later, the premiums can double, triple, quadruple at a certain age. Yeah, you could keep the insurance, but at an exorbitant cost. And that can happen with whole life and it can happen with universal life insurance. So you want to do an analysis of what is the longevity of a life insurance and how that will play into dividing assets and securing the financial. Okay. Now let's let Laura and Ken give us their good advice about the legal matters. I'll turn that back over to you guys.
So
There we go.
there we go. Yeah. I was bragging about left-hand mousing. Only it wasn't working that one. I wanted to unmute. Hi, everybody. We're going to give you some of the legal aspects and how they play into the financial. Ken and I will do a bit of a contrast and compare. He works in the courts here in the San Diego County, and I work as a mediator throughout California, and there's significant differences. One place that's not different is, as Cinda mentioned, financial disclosures are still required. I have people that come to mediation sometimes, they're like, oh, we're mediating. We don't have to share all that information, do we?
Wrong.
Want to explain, Ken? Wrong.
Yes. That's a pretty absolute requirement. Literally, the judge is not allowed to let people divorce unless those disclosures have been done. So it's a very crucial step, whether you're mediating or litigating. It must be done.
Exactly. And it's a continuing obligation. It's interesting. Just this evening, right before I hopped on our seminar, I was working with a couple in their final stages of settling. And he all of a sudden took away her access to the joint accounts. So she's like, huh? So when you sign what's called a marital settlement agreement, when you're mediating, you're working towards what's called an uncontested divorce, no fight, no legal fight, with an agreement. The agreement's a contract. So basic contract law applies. It needs to be voluntary, fully informed, meaning you've disclosed everything, that there wasn't any fraud or misrepresentation, and you entered into it intelligently, which is why we always recommend getting legal and financial advice, because it might be beyond your pay grade to understand what you're entering into. And if you don't basically get these disclosures and you sign a contract, you could very well have a basis that the contract can be reopened. And so you do not want to skip a disclosure. Even though he just innocently thought we're basically about ready to sign, I'll just get on with things, which is what he believes he did. And I don't think there's really any reason to not think that. But I'm like, no, it's just a little too soon. You weren't actually awarded those accounts yet. You haven't signed the agreement. So the signing of the marital settlement agreement, you're under contract to perform. Here in California, what we do then is we submit it to the judge and on top put the judgment paperwork. And the paperwork says at the bottom of the second page, the attached marital settlement agreement is incorporated into the terms of this judgment. Judges like that because anywhere from 25 to 50 pages long that they didn't have to do.
Yeah.
And we have the capacity to swap assets, be more nuanced. This couple that I'm just talking about, perfect example. He's self-employed, so there's business involved. They're delaying the sale of the home until the youngest one graduates law school. They're doing spousal support with a lump sum partial buyout. It's so nuanced. Pretty much all the things we get to do here. She just got her first job after being a stay-at-home parent for 10 years, so we went through all of those discussions. And it's really nice to see that they're able to think like a family instead of a judge. That's the way I look at it. Yeah. So Ken, maybe you can talk a little bit about, first of all, if they're not just giving up those financial disclosures, which they have to do in mediation, it's all voluntary. I don't have power of subpoena, neither do individuals. So what does it look like if they're using the court system and doing it the hard way, I call it?
Yeah. As you can imagine, there are situations where a party will not be forthcoming about their financial disclosures or try to misrepresent or hide information. So there are mechanisms under the law to deal with that. And as Laura mentioned, one of them, attorneys can subpoena documents that send into financial institutions and subpoena bank records, payroll, employee files, everything, documents relating to retirement plans, 401ks, pensions, all of that. In addition, there's the discovery process, which is where an attorney can serve on the other side demands for production of documents or produce documents. They can be interrogatories where questions will have to be answered under oath, all the way up to depositions where you can sit the other party down and ask them questions under oath and walk through documents with them. The thing is that that process of discovery, no matter which tool you may elect to use, can get very expensive very quickly. Going down that path, you really need to have a very honest discussion and evaluation as to whether it's worth it. Because if you're going to spend $20,000, $30,000 on discovery and find a $1,500 account that somebody just forgot about because grandma gave it to them when they turned 17, it's obviously a colossal waste of money and not worth it. I don't mean to be flippant about it, but the bottom line is because of how quickly discovery can accumulate huge attorney's fees, you really need to be very careful about going down that path and make sure that it actually would be a worthwhile endeavor. But there are tools which you can use to find things out, but be careful how to use them. That's how it's
Right. Yeah, it gets expensive. Yeah. And for those of you, a lot of you that we're speaking to tonight and maybe that are going to be joining this webinar at a different time to watch on their own, might be in the initial stages. So let me just give you this advice, and I'm going to repeat what Cinda already said. Information is going to be your superpower, and the correct information will be your super duper power. Disinformation will basically, create all kinds of chaos and problems. Yeah. So think about information needs to be data supported. So I get clients that come in here and they've prepared what are called the FL 142. You can look up the form. It wants to know categorically, do you own any real estate? And then you got to figure out what it's worth. And that's what our realtor would help with, getting a comparative market analysis. You don't have to hire an appraiser. But for example, when it's bank statements and retirement assets and all these types of restricted stock units, your own business, even your child's 529 that they don't own, you own it, you need statements. I create a Google Drive for my clients and we store everything in one confidential place so we can all look at it together. I can't tell you how many clients just do some snippet. I'm like, no, that's not information. It's disinformation because it can be manipulated. We got AI all over the place. That's next month. We're talking about AI. A statement. Okay. So what's the statement? Go to your bank, go to your Fidelity, go to your E-Trade, go to your wherever you have to go, download the PDF version, and that's what you need to share. And it's not wrong to ask for back statements. When I'm in mediation, and you can talk about some of your guidelines when I'm in mediation, first of all, we decide, what's your date of separation? Okay? Because at the time that you decided, one person at least said, it's over for me and all the behavior became consistent, or they signed a lease and moved out, or maybe you've got this mushy period of time because that's often has to be negotiated. As far as the courts are concerned, there's this demarcation that now you went from being a community, two people belong together, partnership, to two individuals. So if you win the lottery after the date of separation, well, good for you. It's not community property, but it's probably going to affect support. Yeah. If you needed a root canal, that might be yours. If the car broke down, or if you ran out and put new tires on it the day before, we might have to have that discussion as well. So time matters. So the very first discussion we have in mediation, at least when I'm doing it, what date you want to use to collect data. Now, just because that's date of separation, and Ken and I worked on cases where even consulting attorney, spouse says, yeah, but my spouse was having affairs with other people and spending it on other people, and I want to see that because I have a right to be reimbursed, because that wasn't a community purpose. We weren't in an open marriage. He or she did this with our money, so I want my half back. So you're entitled to go back. In fact, those cases are often mediated because mediation is confidential. Yeah. So Ken, when people are, just as a basic standard before they start diving down rabbit holes, what should they expect to have to produce? What's the amount of information is just a normal expectation?
That's dictated, as you said, by the financial disclosures of the law, the statutes that cover that. So with regards to the income and expenses, there's the income and expense declaration, which, as the name implies, you list out your income and expenses. But from a documentary standpoint, you also need to attach your last 2 months of pay stubs if you're a W-2 employee. If you own your own business, that gets a little more complicated. It'll expect some Schedule Cs from your company or your business, also potentially K-1s, some type of verifiable documentation that shows what your income is. The flip side of that, or that actually complements it, as Laura mentioned, is that FL-142 form, which is a schedule of assets and debts. And it had all the assets and all the debts you have. So any asset, whether it's a home, you need the mortgage statement, whether it's a bank account, you need the bank statement, but all the current statements that apply to that asset or debt. And one of the things that Laura mentioned that point to bring up here is something to be aware of is like when different assets are valued. For purposes of the disclosure, they just have to be current. Okay. So don't get too wrapped up around the axle on that. But as you go forward, different assets, when it comes to deciding how they're going to divide it, have to be valued at different points in time. So things like bank accounts, checking accounts, savings accounts, pretty straightforward. Those are valued at the time of the date of separation. So that's obviously yet another reason why the date of separation is important. But assets that may fluctuate in value, such as a marital residence, a brokerage account, an IRA, a 401k, those are valued not at the date of separation, but the statute says as a date of trial or when you reach an agreement. The point is that's going to be a moving target because whenever you can come to agreement or you end up going to trial, that current value is going to have to be used to divide those assets. There's just something to keep in the back of your mind as you move forward through the divorce process.
That's a really important point, Ken. I'm glad you brought that up. And what I'm often telling people is everything that's in that community, once you've initially identified it, if it's in the market, it's in motion for both of you. Way back just after COVID, when the housing prices were skyrocketing, negotiations, 1 month, one spouse wants to buy out the other, and then the next month, the other spouse does. And the market was going so fast, nobody could buy anybody out.
Yeah.
And so if something, and look at right now what the stock market's doing. So in negotiations in a mediated environment, you're allowed to swap assets. Do you want to swap a brokerage account like Cinda mentioned? First of all, you want to know the cost basis. Is it all Tesla and Apple stock that was bought when the market was like down here? And it's like, if you sold it, if you got to pay tax on all the capital gain, that's why you need to talk to an expert. But also, so I like to use 401k as an example. So maybe before you got married, you were already employed and had a 401k. Then you got married and you kept paying into a 401k, and then you switched jobs and you rolled it into another 401k, and then date of separation happened and you're still employed, maybe even another company. This is where we need people like Cinda involved. The premarital contribution plus the growth that would have to be carved out belongs as separate property. Everything that you put in there, even though it's entirely in your name, because that's just the ERISA rules, everything that you put in there, even in your employer contributions, all the growth, until the time that you either divide it into two accounts. It's really easy if you just say, everybody gets 50%. But maybe you want to say, I want the house and I'll give you my retirement. Now you have some complex negotiations. Because if you're over 55, and Emily, if you can speak to this, might have Prop 19 sitting in there, you might be able to assume the loan. She's going to have to speak to that. What does that look like? You might have a really nice low interest loan. You might want to, depending on how old you are, you might be thinking, like, there's just so many pieces to this. And how do you compare? You got an apple and an orange, which is fine. You just don't want to swap a crab apple for a juicy orange. You want to be able to identify, are they at least similar in value at the time of a negotiated agreement? They're going to change. If you've got stock, it's going to be in motion. If you got a house, not as much motion, but still in motion. So these are the nuances involved in understanding how to even negotiate for yourself if you're in mediation, or what your lawyer and the financial advisor is going to say. Your proposal is either, I like to look at it when you go bowling as a kid and they put those nice bumpers down so you stay in your lane. I'm like,
I
let's
still
not-
need those.
yeah, I need them to, let's not bull in the other person's lane. It doesn't have to be a strike, but we want to keep some bumpers and guardrails on this whole thing. So
Yeah.
we're all working and talking about the same language. Does that make sense?
Yeah, definitely.
Yeah. I mean, you don't always have to go to trial just because you are working in the litigation world. I think it's worth explaining that sometimes your role as a consulting attorney to couples that are still choosing to mediate, but they're using you as a consultant. Maybe that's worth understanding as well.
Sure. I guess there's 3 ways you can get to conclude your divorce case. Obviously, the most painful and expensive way is to litigate everything, where you're literally going to court for hearings on every issue possible and ultimately end up at a trial where all the issues are litigated. And then at the end of that, the judge makes orders and rulings and you have your divorce judgment. That's obviously the one you definitely want to avoid, if at all possible. On the other end is, I think, the best, most least painful manner is the world that Laura operates in, and that's mediation, where you have a skilled family law mediator like Laura to guide the parties to understanding the divorce process and negotiating a settlement. In that process, each spouse can have what's called a consulting attorney. I have several clients where I'm serving in that role, where myself and the other spouse's attorney, we're not going into the mediation typically, but we are advising and talking to our clients before the mediation, in between the mediation sessions, because there will be different proposals to evaluate and discuss. And ultimately, at the end of that, the mediator, Laura, will prepare the marital settlement agreement, which documents each and every aspect and issue that's being resolved. And each party with their counsel can go through that, make sure they understand it, make sure it accurately reflects what they understand the terms of settlement to be, and answer any questions. There are some occasions where sometimes there's an issue that the parties are just at an impasse. And I've done this with other mediators and Laura, where I and my client, along with the other spouse and their attorney, will come in there and Laura will be the ref and guide the discussion, but work through these issues where not only the parties, but the counsel can have a discussion with the mediator and work out a settlement. And we've had good success with that. That's a role that I also have, which is being a consulting attorney. There's a third version of this, I guess you can call it a hybrid, where we're not litigating and the party's also not in mediation, but each spouse has their own attorney. And through the attorneys, we negotiate, do the back and forth with proposals and such, and ultimately come to a fully resolved settlement agreement. And it's clearly not as expensive as litigating, not as good a deal financially as mediating, but still, it's a successful way to reach the end state without the terrible expense and time of litigating, where the attorneys can work together to come to an agreement and get to the finish line on a fully settled judgment. So those are the different roles that I play in family law cases and how I can get my clients to the finish line.
When we're talking about finances tonight, so I think it's always worth thinking about a cost-benefit analysis to your divorce. There's an emotional cost and there's the financial cost, and they tend to go together.
Yeah.
Because some people really never recover financially, which often means they're not really truly emotionally ready to move on and still stuck.
Oh.
Sometimes I say to people, you have to evaluate if you suspect that there's money missing, you may not find it if somebody operates entirely in cash. But
Yeah.
what you can do is apply some common sense, which of course the courts don't really have a lot of. In my opinion,
They
they
don't.
don't have time for common sense. So a simple model, for example, I had these clients where they're pot farmers and there's lots of cash. So I said, okay, let's just evaluate how much money did you spend each month? And they went, oh yeah, we have a mortgage. Oh yeah, we have some car payments. I just basically, oh yeah, we're spending 12 grand a month as a family. And we have this much in savings and we have no debt. And does it look like that for the last 2 or 3 years? Yep. It's looked like that for the last 2 or 3 years. And guess what? We also have a safe full of cash. So
Yeah.
clearly the tax return that says you made $13,000 is not true. And I'm not a reporter to the IRS, but now you can negotiate just common sense, I call it. Okay, if we spent 12 grand a month and nobody robbed a bank, clearly we had 12 grand a month between us. And we still have not only what we put into an actual bank account, since the pot farmers couldn't really get bank accounts, They also happen to open up a safe and take a picture of lots of cash. So we call Brinks to come and do the cash count. But sometimes even like hairdresser, now we have no tax on tips. The good news about that is people are going to report it on their tax returns. They weren't reporting it before. I think there's a better chance of it being reported. And for those that get tips to the credit cards, if you're working in a restaurant and you tax on tips on top of it, the employer is actually reporting it. But if you're the hairdresser, the nail salon person, the person working odd contract jobs, there's probably a lot of cash. So in mediation, we just take a practical perspective because you can subpoena all you want and nobody's going to win that expensive battle. You're just doing, again, cost benefit analysis. I look at it that way. Let's be really practical. And I actually had a case where husband was a handyman and wife was a hairdresser, and apparently they didn't make anything, but they both had a car and they owned a home. So that's how we did it. We just were really practical about it. And if you stay away from the shame and blame, you're hiding things and you lived on it together, you know?
Yeah.
Yes. It didn't bother you while you were married, probably, or maybe it did. Maybe that's why you're getting a divorce. But there's some awareness there. So I'm just saying, think cost benefit analysis. Is it going to cost me more and find very little? Is there a practical way of doing this? And think of it in those respects. So another thing, when you look at that FL 142, and I invite you all to do it, there's things that exist in the world right now that when Judicial Council created this form didn't exist. So I specifically ask my clients, does anybody have cryptocurrency? Does anybody have prediction market accounts, which is the new one right now? It's been going on. Lots of money, billions of dollars last year in the prediction market. Somebody's got that money in their wallet somewhere. What about a burial plot? What about gold bars? Gold's up 100%. Precious metals. Do you have maybe like a whole collection of surfboards that's worth a fortune here in Southern California? That's a collection. So when it says other each other, be specific. Because the form doesn't ask, doesn't say, do you have these things? So you have to ask each other. And so sometimes you have to be a bit more of a sleuth. Ken, how do you handle that when it's like things just aren't, if you don't ask, people are like, you didn't ask me.
In the litigated context, I'll always try to resolve it without going straight to pain and discovery. And I'll try to maybe informally ask the other counsel, be like, look, my clients tell me there's these other things. You've got a Star Wars collection that's worth of.
Yeah.
They're actually, it wasn't my case, but there was actually a case in another department that actually involved, I couldn't believe how much it was worth. But the point is, you can informally ask, and if the other side has any common sense, they're going to be like, let's just put our cards on the table, because the way to get there is going to happen. It's just, are we going to get there by spending tens of thousands of dollars, or can we just be upfront about everything now?
Yeah.
But if people are not going to be guided by common sense or cooperate, that's when you engage in discovery, which is what I talked about: subpoenas, demands for production documents, depositions, that type of stuff. So there's a range of ways to deal with it.
Yeah. And I think another tip is treating your divorce as your first opportunity, if you haven't already been that person in the marriage, to become financially literate, because you'll never regret that you became more financially literate. Most people that don't fill out their own tax returns also don't know how to read them. So it's worth knowing, like reading it. If your spouse has a Schedule C, meaning they're self-employed, and you know that your dry cleaning bill and all kinds of things are run through the business because that's how you did it as a family, they're not necessarily lying or cheating. They're using the permissible IRS deductions, but in divorce, we call them add backs. So say you were an executive and you got a car and a phone and dry cleaning all included. If you're including it in how you run your business, we add them back, meaning you really did receive that income. It wasn't a true cost of doing business. It was part of a perk. And so look at those types of things as well. Perks matter. Look on your credit card statements. Does your spouse who has to travel all the time for work have $2 million in air miles or 2 million air miles points? You can split those up, or you can even plan that you'll take some trips with your kids instead of just cashing them in, because this is dollars and cents too. Have they worked significant overtime? Is it just sitting in a bank? Or they have 6 months of overtime pay that when they retire, they'll be paid out for the next 6 months. There's some stuff in there that's just not that obvious. And
Yeah.
becoming truly financial literate doesn't mean that you're snooping. It just means you're informing yourself and you're asking the good questions and you're getting good information. I had a client working for a very big company here. It would be very weird for him to not have a 401k. He said, no 401k here. A Monty Python sketch. No. So read your W-2. I just put his W-2 on the screen and went, oh, can you just read box 12 there? What does that say? Yeah. So there's on your W-2, below your W-2 is code in like size 7 font that explains what each box is. You should read it. It's your family's money. Why not understand? Hey, wow, we spent $20,000 on the family's health insurance last year. What's it going to cost me when I don't have that? Oh, we only put $5,000 into retirement. Is that a good strategy? This is an opportunity that is a missed opportunity often in marriage. Do you find that too, Ken? I think strangely, I don't want to criticize it, but I think the litigation process, what happens is the litigant puts blinders on, and my attorney's doing that. And it's not as engaging for the individual to take ownership of their divorce. They treat it as a more passive process as happening to them.
Yeah.
I encourage all of you to not let divorce happen to you, but participate fully. Is that fair?
No, that's a good point, babe. And I think because people in litigation, by its nature, it's very confrontational. So their attention is really drawn into the fight, so to speak. And then along with that, they're missing a lot of details because they're worried about making deadlines.
Yeah.
They're worried about what counter arguments can I make at the RFO hearing that's coming up, listing every single thing they can think of to rebut the tiniest point that was brought up in the other side's RFO. So I think there's so much noise associated with the litigation process. And I try to keep my clients focused on what really matters, but it's hard. It really is because litigation it's a very noisy and turbulent world that's tough to stay focused in.
Yeah. And it's hard to understand.
mediation.
Yeah, it's hard to understand because you get stuck in a process as opposed to digesting your process.
Correct. Yeah.
Yeah, that's what
So
it
we're
is.
actually looking at the substance of what you're putting out there. Yeah.
And so I think for all of you, even if you're in a litigated experience, go back, look at every single financial document and learn, what do we actually have? What are we arguing about? What do we owe? Did we owe it during the marriage or did all this happen afterwards? Kind of thing.
Yeah,
And just really make yourself financially literate because it's going to help you after divorce as well. Because you're going to have a post-divorce budget, a new reality, and responsibility for your new situation. It's going to be part of preparing your next runway. And I think it's worth talking about coming back after there's a judgment, because we have a lot of people that are also interested on this webinar learning, okay, can I come back? Not for assets, right? Ken, you want to explain the difference between?
Yeah. So when it comes to asset and debt division, once a judgment's entered and you sign a settlement agreement, you're stuck with it. There is this thing called the omitted asset, meaning if somebody did not list it on their FL 142 and it was never adjudicated in the divorce or never listed even in a settlement agreement, you have the ability under the family code to have the court reopen your case and to address dividing that omitted asset. So there's that. But the thing is, that's rare because it literally has to be completely neglected and left off of everything. So don't count on that being like, oh, I should be able to reopen it. It's very difficult, is the reality. So that's the issue of asset division. However, there are many issues that come up that are subject to modification because, for example, child custody visitation issues, orders. If there's a significant change in circumstances, the judge can relook at that. We can reevaluate it. The same goes for child and spousal support orders. Assuming there's no provisions in there about non-modifiability, they're always subject to modification if there is a significant change in circumstances, which could be a host of different things, but typically involves either one party earning more or losing their employment or something happens where they earn less. So those are always subject to modification. That is something that's totally separate from dividing assets. Right. And keep that distinction in mind.
Yeah. And a lot of people, even if they've litigated, I have found that I've had people come to mediation just post-judgment to modify child or spousal support because the cost of doing that in court is almost never going to be equal to what the modification is. Almost never. It's just too expensive and too slow. Any of my clients, and some of my clients, because they mediated, we do annual true ups because it's so complex. Restricted stock units, or I have a
Right.
couple where one is a commercial realtor and one is a residential realtor, and every year their income's different. So once a year we true up and we make it so that this is what you owe and this is the baseline for next year. I have a
Great.
client recently got a massive inheritance, and husband said, okay, I'm not going to pay her spousal system anymore. Now, what do you mean? That's my separate property, which is true, but it's providing her with income.
Yeah.
So her need changed. His ability to pay didn't change, which could have
Yeah.
been another factor.
Yeah.
But she had a need that went away, very away, by the way. And she doesn't have to pay him support, even though technically she now has even more money than him because
Yeah.
she's still receiving child support,
Yeah.
because that didn't go away.
No.
But it got looped in
Of
to
course, yeah.
overall income.
Yeah.
So sometimes separate property, but is it kicking off income? I'm having this conversation with a mediation client, and he's going to have to talk to Cinda probably because he can't wrap his brain around it, because he's been allocated stock, restricted stock units as separate property, and they're swapping. Wife's keeping house, he's keeping more stock. It's kicking off income. He doesn't want to pay support based on the income it produces, because he said, then we should charge her as though her house was producing it. He could turn around and buy a house with his, and he wouldn't have any income from that.
Yeah.
But that's the law, Ken. Yeah, it's the law.
Yeah.
So
Just do it.
yeah, some of this isn't straightforward. We didn't mean to blow anybody's brains up tonight, but
Yeah.
but we do want you to know that information is a superpower. Correct information, super duper power. Disinformation, tragedy. So that's what we have for you tonight. I want to turn you over to our real estate team. Unfortunately, Kelly, who's our realtor, had a family emergency. She couldn't join us. Emily is going to take it on for us. She is wonderful, expert in her field. And we'll join you when you're done there, Emily, before we answer questions from the crowd to help you out if you have any other things we can help you out with. Take it away.
Okay, amazing. Thank you, Laura. Thank you, Ken and Cinda. You guys are an amazing team. I swear every time I listen to you speak, I learn more and more. I really appreciate you. And I love how just thorough and creative you are when in a situation like this. I think that's just so important, where it's not, there isn't anything that's black and white. It's just deciding the individuals that you're working with and the families that you're working with and what makes the most sense. I think it was Laura and actually Cinda that talked about trading assets for real estate or whatever the situation might be. And I have seen that happen depending on the family situation. And if there is a spouse that really wants to hang on to the family home, if there's young kids that are still just growing up there and they don't want to make that change on the family yet, there are so many creative solutions. And as I mentioned, I'm a mortgage broker in Encinitas for over 20 years, a broker owner, which allows me a lot of flexibility. I probably work with 40 different wholesale lenders depending on the situation. So some of us are, especially in California, there's a lot of entrepreneurs here. So self-employed people don't necessarily show their income on their tax returns. So we have a lot of creative bank statement programs, asset allocation, asset depletion programs, just different ways to pull money to help you qualify for that mortgage that you might be looking for. Because really, the decisions made during a divorce, they have such a long-term financial consequence. Our job as a team with Laura, Ken, and Cinda, Jennifer, who's our realtor, our job is to just look at everything and really give you the best advice possible and work with each other and see how are we positioning these partners with this separation and what is the best way that we can position them in for their future. So when dealing with real estate, it's really the three choices are selling the home, retaining the home, or deferring the sale. So what we'll work with it in our discovery phase, and that'll often happen with myself and with Jennifer Cheney, who's amazing. She really knows the ups and downs of divorce. She knows how to work her magic around all of your options, and more importantly, how to handle both partners in the best way possible. Because that's what we do, is try and just alleviate the situation, stay calm and unemotional, and just help you with our expertise in the best way that we can. In selling a home, obviously we know what that is, and that would be working with Jennifer or another realtor that you trust. How she is an asset, she just has a full grasp on what it takes to analyze value of the property to make sure you get the most out of it, what your expectations are in navigating the sale process, and what may or may not be the most congenial circumstances with a partner. And then once you do decide to sell, what does that next step look like? Are you going through a pre-qualification process to see if it is time to buy? Is it more of a rental situation? And where is that rental? Is that affordable for you? Now being on your own, what do those payments look like? And can you, for me as a mortgage broker, I always want to make sure you can maintain your same standard of living now that you're doing this independently. The worst thing that I see sometimes is that it's either the one spouse that takes over the home and it just becomes unbearable financially. And it's really hard to backpedal and say 6 months after that agreement has been made to keep the home, and they no longer can do that. So as Laura mentioned, that's like you're really skipping out of that capital gains ability to have $250,000 per partner at the sale, since you're the one retaining the home, that now is just you, and that you gave away the full $500K. So there's a lot of tax repercussions. I try not to go too far into that because that's more of a CPA. I do have a knowledge base and just trying to advise you in the best way that I can. Again, it's either selling the home and retaining the home. That's oftentimes where I come in to just look at finances. That's the first thing that I do, is to see how stable are you? What does your income look like? What are the assets look like? Your debt to income ratios? What does credit look like? Have you checked your credit lately? Oftentimes I'll do a credit repair just to make sure that our balances, when going through a divorce, credit cards might become a little heavy because maybe that's how you're living for a while. I've had a lot of women, mostly, maybe they're going from part-time to full-time, and to bridge that gap in income, they are a little more dependent on credit cards and other things that can pull down credit scores over time. So I look at that. Is it a circumstance that we can improve your credit? Normally it takes me, as long as the spouse is active, maybe 10 days to repair credit. And I've seen them jump up 140 points in some circumstances. So that's a huge difference in interest rate and affordability level. We'll review that. We'll look at long-term sustainability. What is it going to take for you to maintain that home? What is the upkeep of the property? What is the maintenance of the grounds, water bills, gardeners, possibly pool cleaners? There's just a lot that maybe one spouse was in control of and the other spouse wasn't. And maybe one spouse was writing the checks and the other one was just talking and making sure everything was organized. Just having a full grasp of what it takes to retain that property, and if it's something that you see yourself doing long term. So that's really important. In deferring the sale, that's often common with children, when children are involved. And will both of you remain on the loan? And if so, that means that you're both held accountable for any late payments, anything that might happen to credit. And I have had that happen, where the one spouse that retained the home and the other spouse remained on the loan, and she went late for several months on the mortgage, and he ended up wanting to get remarried and buy a new home, and checked his credit, and there was no possibility anymore, at least for several years, to buy. So that's an important thing, to just make sure that you're checking that box, that what you're liable for and what potential ups and downs might be. The other one is, once it does come time to either sell or refinance that property, divorced couples look at it as when the youngest child is of college age, or there's just a set in time and date of when they're going to sell the property. So it's also being realistic. Is that person going to be fully employed at that time? What are current market rates? What do those look like? Is it feasible that they can take over the property? And if it's not, what is plan B? Is that selling the property? And do you think both parties are going to be in agreement on that? Those are like the nuts and bolts of looking at the sale of a property, the retention of a property. In California, a lot of what I do with my clients and with my brokerage is I help them build investment properties. I'm a big investor, and I truly believe in that, to build wealth. So we do see a lot of divorced couples that maybe have multiple properties. I have a client right now that has as their main home, and then there are multiple investment properties. So we talk a lot about a trade. Maybe it's trading this duplex for the much larger in value family home, or maybe it's trading a large portion of her share in another single family home that they own in order for her to retain the family home at a comfortable loan amount and possibly even pay down the principal. And that's another thing that comes up is the mortgage assumable. That's a huge thing right now because we are coming off of the COVID years when rates were just insanely low. So those 2.75 or 2.5%, we're not going to see, possibly never again in our lifetime. So a lot of people want to assume that loan. That was a big win. And I totally get it. And I have called even for clients to say, is there any way that is this loan assumable? And shockingly, one of them was. So that's a possibility. So we just hope you discover all routes, especially financially when it does come to the family home again, because that usually is the largest asset. And we want to make sure that if you do decide to retain that as an individual, what that looks like going forward and what is the sustainability of keeping that property. So that's a big concern. We're a huge team here to help out in any way that we can. And we collaborate together and just try and figure out the best path possible. I'm sure Jennifer Cheney, who is our realtor, she'll be on here next time and just talk you through her story of divorce and what she dealt with on a personal level and kind of what she sees in her day to day. So she's wonderful to talk with, even if there's a no charge, just a discovery zone that we just love to help educate you and see how we can help in any way possible. So thanks everybody for listening, and I'll bring back the team if everybody's there and talk about what our next project is.
All right. Thank you, team. Yeah, hi there. Thanks, everybody. Yeah, I love that you're sharing some of the real estate aspects because we get to do that in mediation. Ken doesn't have that opportunity because usually it's interesting. One of the trial attorneys I talked to, Ken, you might agree, they said nobody gets the house in divorce because it always gets sold because there's nothing left.
That's it.
Financially.
That's all the judge is going to do
Yeah.
too.
And the funny thing is, he was actually reaching out to me to ask me for one of my creative clauses that I'm known for writing because he's never had to write one. And so just
never get a
to
chance to.
understand it. Yeah, I couldn't understand. Say, I just finished drafting one today where wife is going to assume the mortgage. Like Emily says, she's already done some pre-qualifying investigation. She knows financially she's going to fit that. So husband's going to not be on title, but he's going to stay on the mortgage, which may sound risky. But the marital settlement agreement is drafted. The language I've drafted in there says that if she's late 2 months in a row, that she's considered in default. If she's late 3 separate times in 18-month rule, she's in default. Husband can call off. He can also keep everything current to support make sure his credit score doesn't go down with the ship, like Emily said happened to that other person, and then be reimbursed with interest. And I made her put the house in a trust. And if she died and he's still not off the mortgage, so we also are requiring that once judgment's received within 30 days, she provides written proof, and keeps husband in the loop that she's applied for the assumption. In this case, he said to her, 99.9, we know you're going to qualify. If you don't make it, I'll give you 3 extra years. That's when their daughter will graduate high school. He's doing it for the family. So they collectively built a negotiated deal. Now, did she give him something back? Guess what? She got a 3.1% mortgage rate that has 24 years left on it.
Wow.
She's got the property tax basis that's low because she didn't have to buy the property for its present value. So her property taxes ongoing are that. And the children get to live in it. They get to finish raising the children in the home in the school district. So we think of this as the emotional value to the family, financial value to both of them, because guess what? We talked about need and ability to pay. She's only paying $2,300 for a mortgage. A similar house to rent would be $4,500. So her needs are down, and so she doesn't need as much support. So the family as a whole has extra money to spend as a family because they didn't just blow the whole thing up and go, you can't have the house. No, you can't have the house.
So smart. So smart. If you can keep the control, yes, and be patient, let it play out.
Yeah. So there's so much intrinsic value that you want to think, and it just you gave your spouse something, it's a negotiated item. They got something they'll never get without your agreement. So
Absolutely.
It's not a straight dollar value, but that's when support started to get negotiated. So think of assets and support as sometimes having a little bit of connection. Another one I just worked on today where, again, a delayed sale, house is going to be listed July of 2030. Husband is going to be bought out of his remaining equity in the home upon sale. So he's accepting a delay. What's that worth? So it's made up for in a few other assets. You know, if you're I get to use your money and live in the house with our children for 4 more years, and I don't have to pay you out now, and you don't have enough money for a down payment now. What do you want to give me for that? So this is why you meet with someone like Cinda, someone like Ken, even me as a divorce coach, if you're not using my services as a mediator, it can't be both, to come up with strategies. Think strategically about a proposal, not a complaint, not an entitlement, not a victim statement, an actual thought out proposal. I propose, start with I statements. I propose that I stay in the home, and this is what I'm willing to offer you in exchange if you are willing to let me apply for an assumption. I've met with the broker. I know I meet the credit worthiness. What have I done? Not just, I want the house, because I've had people negotiate. Okay, I want lots of things. It's like the
That
kid at
doesn't
the end of
exactly work for anyone. Yeah.
at the grocery store laying on the ground going, I want candy. They do, but
Yes.
we all want candy, but we can't all have it all the time. Yeah.
Yeah.
Yeah. It's such a collaboration. That's when things actually work rather than, I think it was Ken that was said, if coming at each other, it just doesn't work. It's such a collaboration and just distilling the emotion and trying to figure out what is the best for everyone.
So we're going to hit some questions now.
Right.
And thank you for those of you who've been able to stay. We've got a ton of questions. We'll do our best. And let me get to the Q&A. So who wants to read them off? Who's got some better eyesight than I have?
I could see.
Some we might have answered. Let's
Oh,
see.
here we go. Q&A.
So someone's asking about a transmutation. Okay, so maybe Ken, you can explain what transmutation is, because I don't think what I'm
So-
briefly seeing doesn't sound like what it. Yeah, go ahead.
Yeah. So transmutation is a legal term where it converts the characterization of property. So the situation that I'm reading here, as I read it, is transmuting, meaning changing what was previously a separate property asset, the house, into community property. So that's in fact specific question. What I'll say is this: typically, if someone owned one of the spouses owned a home by themselves before marriage, and during the marriage, then community money started being used to pay down the mortgage, that starts to create this creeping community interest in there. A lot of times, typically a refi, you probably didn't realize it, but typically when you do a refi and then you put the other spouse's name on the title, that typically is enough to be a transmutation, even if you didn't fully realize that. I know what the family code says, there had to be a specific language. It's not really a magic word like the Necronomicon thing, but it depends on the specifics of your situation. But the general concept is typically there's a change if you did a refi and added someone to the title, but all hope is not lost in the sense that it doesn't mean that instantaneously a magic wand was waved and the whole thing is now community. There's this apportionment that has to be done. It's called the Moore-Marsden apportionment. That's where you get a math smart person like Cinda, and any attorney that says they can do it, don't believe them.
Don't do it.
Yeah, but the bottom line, though, there is a prescribed way to apportion the interest, because obviously the separate property interest for the spouse that owned it beforehand and the principal that was paid down and the appreciation and value before the transmutation is separate property. The community has to be apportioned what they help pay down on the mortgage, and then ultimately the community portion of the appreciation. That all has to be figured out and divided up. But someone like Cinda, who is a CDFA and who understands how that is supposed to function, will do that analysis. So that's what's got to be done in a situation like that.
Yeah, the premarital years still matter.
Correct. Yes.
Yeah. And sometimes even I had a couple the other day where, just like Ken said, where she went off title because it was better for the mortgage to be put in husband's name, and the escrow should know about common Then you're going to have to inform them.
I know,
They never
right?
put her
Yeah.
back on. She doesn't have to
It's
go on
not,
title
they
just
don't,
because she's
no.
not on the mortgage,
No.
but she
Yeah.
wasn't put back on. And her worry was, I'm not on title. I'm like, the common law rules prevail.
Yeah.
This was
Mhm.
incidental to her.
Finance.
If she wrote him a little lovey letter like, honey bunny, I love you so much. I want you to have the whole home and nothing but the
Yes.
home. So help you
I
God.
hereby
It's all
bequeath my
yours.
community interest.
Yes,
Yeah,
yes.
Stop.
And I know I'm giving up my community property and I'm not crazy and haven't taken any pills today. So I want you to have it anyway.
yeah. Barring
It's high
something.
standard.
Yeah.
High standard. Yeah.
Yeah.
Yeah. They don't presume the community interests rise above
Yeah.
unless you literally gifted it to someone.
Yeah. Has to
an
be like
explicit gift. Yeah. But the transmutation wouldn't transmute the whole thing. Yeah.
No, the
Just
portioning has
More,
to.
more Marston. Yeah.
Yes.
Trying to understand this one about some of these are too specific, by the way.
Mm.
They're more.
About the TSP.
Yeah.
Yeah.
Okay, go ahead with that one.
Yeah. Any pension or a TSP, it has to be divided. The community interest has to be apportioned. Again, you're going to need a CDFA, a financial expert, to prepare the order. The different federal plans they have, sometimes it's called a QDRO. Usually they have something called just a DRO, domestic
Yeah.
relations order. But I think Postal Service and other agencies, they have this different terminology. It's called a COAB, a court order acceptable for processing. But the objective of it is the same. It's to divide the community interest in that pension or DSP plan.
Yeah. And you'll have a time
You're gonna
rule.
be an expert that does that.
Yeah. So the QDRO preparer. So usually what happens when you're mediating, the mediated agreement will say this is going to be a time rule. Certain
Yes.
ones are time. So meaning like if you were working there before you got married and then you got married and then the marriage was 10 years and then you're still working there, the time that you were working before you got married, the time after is your separate property.
Yeah.
The
It's a
community,
fraction. Yeah.
50%. So it does the math. Then it goes to a QDRO or DRO prepare. That's their whole job. That's all they do. And then they send it to the fund manager, whatever the organization is, to approve it.
Yeah.
Then it goes to the judge to become a court order. Then it goes back to the fund to execute and it's put into two separate pots, mine and yours.
Yeah.
And if you're still working there, so it's slow and Q in qualified domestic relations, or it means there's been a qualifying event, meaning a divorce.
Yeah.
So if you don't get a divorce, if you suspend your divorce for some reason because you're trying to keep health care or something going on, it hasn't been a qualifying event yet. So it can be a little convoluted. And it usually takes a good 6 months if you're talking about the federal.
Yeah.
Ken's former JAG officer, he knows how slow those are because that's part of his specialty.
I
And
can
I
do the
think-
military ones. The other federal
Yeah.
plans are.
But
it's-
USPS is probably the same idea. It's a federal government plan.
yeah.
Well, it won't happen as fast as the mail's delivered. And mail's pretty much all on
probably-
time as far as I'm concerned. So it won't happen
Yeah.
that fast.
But there are people who specialize that
In
they
that
will get the language correct.
Yeah.
Each agency, whether it's a private run plan or a government run plan, they have the administrators have specific language required, and these individuals who know how to write these orders, they're tapped into that and they'll get it right.
And somebody would go ahead.
Oh, just real quick, one of the things that people want to be aware of is if you go to CalSTRS or CalPERS statement, sometimes one person will say to the other one, knowing or unknowingly, oh, that's the value of the plan. But with those plans, you need to know the present value of the plan, and that is not shown on those statements. So don't
A great point.
trade those dollars so you really know what the value is.
Yeah.
Exactly. Again, you got to know that. And if you're swapping a pension, which is you don't know how long you're going to live. I did have a couple not that long ago decide he is type 1 diabetic and he's 62. And he goes, I'm not going to outlive her. Her parents are like 97 and 98 years old, still kicking and live together. And she's only 62. So he said, I want to take more 401k dollars and load her up on pension because she's for sure going to outlive me. Again, it was an opportunity for a negotiation based on nobody had a crystal ball, but he's realistically, my life expectancy is not hers. And he did have a lot of secondary health issues related to his type 1 diabetes. And so I'd rather she have the pension. I'd rather have the money up front in case I want to blow it all on my end of life trip around the planet kind of thing. And so you get to negotiate sometimes based on what matters to you. And similarly, when I've had cases where one party is much older, typically it's the man and it married a younger woman. And her concern is he might die and before spousal support runs out. And he's too old to insure. It's too expensive. So we've had clauses where there's been a trust set up, and if it's not needed, wife dies soon, it goes back to the family. It's been built into the actual, it's built into the whole agreement that she's not going to run out of spousal support if he dies. So these things are unique to mediation kind of thing.
Yeah.
There was something here about, I caught my eye a minute ago. Oh, somebody wanted to take money out of retirement. Did you hear the word community?
Yes.
Okay. Once you start a divorce, you're both under automatic restraining orders. And what that means is you can't just use your assets without agreement. So if your spouse wants you to take out $20,000, your next question is, who's paying the taxes? Are we still married filing joint? Is that the best way to do it? Sure, you're 59 and a half, you don't have a penalty. But unless it's Roth, it's not tax-free. And giving it to your wife, half of it was already hers. So you didn't give her 20,000, you gave her 10. Half of that was already hers, unless you're swapping. So
Yeah.
try not to start draining joint accounts and joint assets until you know the whole picture. Sit down with somebody like Cynthia and say, okay, you've got extra of this category that you could swap with, but if you start cleaning out one or the other, you can run into tax problems and you can run into, wow, I thought I wanted more retirement because I'm younger than you.
Yeah.
Wanted to have it when you weren't going to pay me support anymore kind of thing, that you cashed it in. Don't be preemptive would be my recommendation. I know you see that. How do the courts treat that when somebody's gone off willy-nilly and they haven't really responded appropriately to the automatic restraining orders in place? Like they've just cashed in.
We'll penalize the person who violated the automatic temporary restraining orders. And depending how egregious the violation is, sometimes you'll have things like somebody remove someone from life insurance and they can put it back. I recently had a case where someone removed the one spouse from their employee health insurance plan because it's just to be spiteful. And sadly, my client came down with a cancer diagnosis. So the spouse is okay now, but the point is there were substantial costs to my client because of that. And the court ordered dollar for dollar to be reimbursed. And it was a chunk. The court will take action on those ATROs if someone willingly violates them.
Okay. Somebody was asking about potential inheritance. So first of all, things that are separate property, Cinda mentioned a list. So if you received a gift, it's always like wedding rings come in all the time. Wedding rings come in all the time. Will you marry me? Yes, I'll marry you. Yes, you did marry that person. It was a gift. You don't have to give it back. You don't have to divide it up. It's not community property. And he can keep the lawnmower you gave him for Father's Day and carry on. But if you haven't, so inheritance is if you kept it separate, stays separate. If you haven't received it yet, there's nothing to split. And if you receive it in the future, unless it changes your ability to support yourself, like we spoke about, your spouse never gets a piece of it. They just maybe owe you less support.
And that's the key distinction. There's this difference between dividing an asset or how that asset may affect the support obligations. Tough to decipher, to separate sometimes, but that's a key distinction to keep in mind.
Yeah. Especially when somebody's passed away and this probate's going on and somebody thought, oh, do I have to list this? Well, it's not an asset yet, but in full disclosure, it's fair to say that somebody passed away. I know I'm a beneficiary. It's in motion. I will let you know when I have a material change in circumstance. In other words, I just got $500,000, so I get that. In those doors.
Yeah.
I had a case where they agreed that when wife's father died, they knew that she was going to inherit several $1 million, and they just put it in the settlement agreement that when that happened, then there won't be any more support. And
exactly.
So there was a kindness and a consideration. There are cases where you're never going to see that. They're going to have to hammer it out in court, but Well, we should encourage people to explore the alternatives that may allow people to come to an agreement.
Yeah, and that's a wise idea. Yeah, and someone asked if they're in mediation, do you have to provide the financial information ahead of time? So I don't know what you mean by ahead of time. The start of mediation is usually the start also of the legal proceedings, unless you started them on your own. Usually in the very first session, I have drawn up the petition, and in this case now we have joint petitions, sign them in the first session. If you have a joint petition, you're under automatic restraining orders that day, because now you know you're getting a divorce.
Yeah.
And so your obligation to provide financial disclosure, the rules of court say you have 60 days, 60 days to exchange information. So do you have to do it ahead of time? Not ahead of mediation, but once you start this process, which is another good reason to get started, instead of
Yeah.
thinking, we can't get started because I don't have any information, because of one of those circles. So
Yeah,
when we get
exactly.
started, now you have to provide the information. So that's another good reason. Just don't drag your heels thinking, if I had everything, I'd start.
Yeah.
You don't know if you have everything until you get started.
That's great.
Chicken and egg. Yeah. And sometimes in my coaching practice, because I'm also a legal document assistant, people come to me and they're like, my spouse won't consider mediation, but I want to get this started, and I'm hoping he or she will still reconsider. So sometimes I just file their pleadings for them, serve them by mail with a nice, polite letter. I said, you probably aren't going to hire me as your mediator because I'm already the coach, but your spouse would like to do this cooperatively. Here's the names of 3 mediators he or she has selected, open to interviewing your options. Are you willing to proceed in this manner? Just because sometimes people are just afraid, but they want it started. And so it starts the ball rolling that you file for divorce. But the person filing is the one under the automatic restraining orders. The other person not until they have noted
Yeah, they're
by
served.
getting served. Yeah.
Correct.
What else are you seeing here, everybody? God, there's so many. We only have,
I know.
oh, we got a minute.
Okay.
Imagine question can you answer here? There's
Just a
so
quick
much.
one, disclosures, current statements. That means is the date that you're completing the disclosure.
Yeah. But
It even
again, we're
says it
going
on
to
the
talk
form.
about date, because he might,
Yeah.
I had a couple that came to see me and then came back 4 years later. In between, wife had breast cancer.
Yeah.
And
Okay.
they thought, or I would say she thought they'd reconciled. He said, no, I was taking care of you. So now what's your date of separation? And what date do we need statements? So this is part of the discussion, and they can always ask for more.
Sure.
Okay. So it's not a 1 month disclosure, because
Yeah.
the last 6 months.
You can supplement them, and a lot
Yeah.
of times you'll have
Yeah.
to, because
Yeah.
like we said at the beginning, there's certain assets that the
Yeah.
value fluctuates, and when you
Yeah.
finally reach an agreement, you got to use that point in time.
Yeah. And so how we do it in mediation is I ask my clients, what date do you want? Do you just want last month, or do you want all year?
Yeah.
Because why have to keep supplementing it? Why not do the task once? Because it's all going to come out anyway. So why not just say, okay, how far back do you want to go? I'm willing to be completely transparent.
Yeah.
Like Cinda said, no more than 7, because banks don't have those documents.
Yeah.
But sometimes
It's
for
kind of a
tracing,
natural
you're
cutoff
trying.
built in.
Yeah, digging up old escrow statements for when you bought the home because you put the down payment in, something like that. Guess what? We're back every month. In fact, next month we've got 2 different options. If you're local, we have a live session in Carlsbad. We can only accept 15 people, so limited, because we want to have a personal evening. And then we're going to have another webinar online. We are going to be talking about how to use artificial intelligence to supplement your process, and how not to use it, like where it can get dangerous for you, because it's out there. We all are using it, even as
Yeah.
professionals. How to ensure your privacy is protected, how to use it to do some of your math sometimes and to help you facilitate negotiations, and how much information to just not upload everything into ChatGPT, like all your statements, and hope that your personal life has maintained some sense of privacy. That's going to be next month. We're here every month. Thank you so much for joining us, and I do hope you enjoy the rest of your evening, and bye for now from the Carlsbad Hub of Vesta Doors.
Thanks for
Good night,
joining.
everyone.
Thank you. Good night.